I don't think people understand the true key to investment success. Peter Lynch, one of the most successful investors of all time, often emphasized the importance of mastering one's emotions. In the realm of investing, your greatest asset isn't necessarily your intelligence or your bankroll. While these factors play a role, they are overshadowed by something far more critical. It's your ability to control your emotions. This emotional control is what sets successful investors apart from those who falter. Fear and greed can derail even the most promising investment strategies. When the market plummets, fear can trigger panic selling. Mastering your emotions is essential for making sound decisions and achieving long-term success. It helps you remain calm and composed, even in a volatile market. Think of the stock market as a roller coaster. Just like a roller coaster, it has its ups and downs, and it can be both thrilling and terrifying. There will be ups and downs, twists and turns. These fluctuations are a natural part of the market cycle. It's easy to get swept up in the excitement of a bull market or to panic during a downturn. The emotional highs and lows can cloud your judgment, but reacting emotionally often leads to poor decisions, like buying high and selling low. This is a common pitfall for many investors. Instead, cultivate discipline and patience. These qualities will help you stay the course and avoid making impulsive decisions. Develop a sound investment plan and stick to it, regardless of market fluctuations. A well-thought-out plan can guide you through turbulent times. Remember, investing is a marathon, not a sprint. It's about long-term growth and staying committed to your goals. By mastering your emotions, you can stay focused on your long-term goals and navigate the market with clarity and confidence. This emotional resilience is key to enduring market volatility. This emotional intelligence sets the stage for making smart investment choices. It empowers you to make decisions based on logic and strategy rather than emotion. Fear is a powerful emotion that can paralyze even the most experienced investors. When the market takes a nosedive, it's natural to feel a knot in your stomach. But acting on that fear can be disastrous for your portfolio. Remember, market volatility is like the weather, unpredictable but inevitable. Prices will rise and fall, and that's part of the game. These ups and downs are what create opportunities for the astute investor. Instead of dreading volatility, learn to welcome it. See market declines as a chance to pick up great companies at bargain prices. This requires a shift in how you view the market. Instead of seeing a falling stock price as a loss, see it as a potential steal. By understanding that volatility is just part of the landscape and using it to your advantage, you can turn fear into opportunity. This mindset shift is essential for achieving long-term investment success. I'm sure you've heard the news. Peter Lynch's Beating the Street is a treasure trove of stock market wisdom. In this series, we'll dive deep into how ace investors find opportunities in disguise. Market declines can be unsettling, but they're far from the end of the world. In fact, they often present the best opportunities to buy quality stocks at bargain prices. Think of it like a sale at your favorite store. When prices drop, smart shoppers rush in to snag the best deals. The same principle applies to the stock market. When the market takes a downturn, don't panic. Instead, see it as a chance to buy shares of companies you believe in at a discount. Remember, the stock market is driven by emotions. When fear takes hold, prices can drop dramatically, even if the underlying businesses are still strong. This creates an opportunity for patient investors to buy undervalued stocks with long-term growth potential. Unleash your investor's edge, profit from what you know. Peter Lynch often shares the secret of the investor's edge. It's not about having the fanciest algorithms or insider information. It's about tapping into your own unique knowledge and experiences. Everyone has a field where they know more than the average investor. This could stem from your job, hobbies, or community involvement. For example, tech workers might notice emerging trends and startups before others. Gamers might spot the next big game company before Wall Street analysts do. By investing in what you know, you can uncover undervalued opportunities and make smarter decisions. This approach empowers you to take charge of your financial destiny. Categorizing companies. A framework for decision-making. Peter Lynch, with his knack for simplifying the complex, breaks down the investment world into 6 distinct categories. This approach helps investors zero in on what truly matters. Each category has its own story and set of characteristics, guiding investors to make choices that align with their goals and risk tolerance. Slow growers. Think of these as the tortoises of the market. Big, established companies that grow slowly but steadily. They're the industry giants with a track record of stability. These companies are the bedrock of a conservative portfolio, offering reliability and consistent returns. Stalwarts. These are the dependable workhorses. Large-cap companies with moderate growth, offering a blend of stability and growth, ideal for those who want a mix of security and the potential for appreciation. Fast growers. These are the hares, smaller aggressive companies with rapid earnings growth, often in emerging industries. They're riskier, but can offer substantial returns, perfect for those who can handle a bit of volatility. Cyclicals. These companies ride the economic waves. Their performance ebbs and flows with the economy. They can deliver significant returns during booms, but may struggle during downturns. Turnarounds. These are the comeback stories, companies facing challenges but showing signs of recovery. High risk, high reward. They're for those who can spot a diamond in the rough. Asset plays. These are the hidden gems. Companies with valuable assets not fully reflected in their stock price. It takes a keen eye and thorough research to uncover these undervalued treasures. By understanding these categories, you can better assess a company's growth potential, risk profile, and fit within your portfolio. This framework helps you narrow down your options and focus on the most promising opportunities, leading to a robust and diversified portfolio. Pause 2's Lynch's Winning Formula, a step-by-step guide to stock selection. Peter Lynch's investment approach is like a treasure map for investors. His methodology has not only stood the test of time, but also remains a beacon for both novice and seasoned investors. He lays out a step-by-step process for evaluating companies, offering a clear path for investors of all levels, from beginners to experts. This structured approach is your guide to making well-informed decisions. First, categorize. Identify the company's category: slow grower, stalwart, fast grower, and so on. This helps you understand its general characteristics and growth potential. Next, analyze the story. Dive into the company's business model, products or services, competitive landscape, and future prospects. Look for companies with a compelling story and a sustainable advantage. It's like finding a hidden gem in a sea of rocks. Then, examine the financials. Get into the nitty-gritty. Scrutinize the company's financial statements to get a clear picture of its financial health. Analyze revenue growth, earnings per share, debt levels, and cash flow. This will help you assess the company's financial health and growth trajectory. Assess the valuation. Determine if the stock is reasonably priced relative to its earnings, growth potential, and industry peers. Look for companies trading below their intrinsic value. It's like finding a bargain at a flea market. And finally, monitor progress. Once you've invested, keep tabs on the company's performance. Track earnings reports, industry news, and any factors that might impact the business. Stay informed to make timely decisions. By following this structured approach, you can make more informed investment decisions based on thorough research and analysis. This process helps minimize emotional biases and encourages objective evaluation. By sticking to a well-defined strategy, you can navigate the complexities of the stock market with greater confidence and clarity. Scene 7, the power of patience and long-term thinking. Emotion 4, music, inspirational, uplifting, serene. Now that you have a solid framework for selecting stocks, it's crucial to understand one more key element: patience. Investing is not a get-rich-quick scheme. It's a long-term commitment. Peter Lynch often emphasized the power of holding on to good companies for the long haul. Pause 1's. Patience allows you to ride out market volatility and benefit from the growth of your investments over time. It's about believing in the companies you've chosen and giving them the time to grow and flourish. Remember, the stock market is a device for transferring money from the impatient to the patient. Pause 1's. Lynch himself held many of his best-performing stocks for years, even decades. This long-term perspective not only minimizes the impact of short-term market fluctuations, but also maximizes the potential for compound growth. Pause ones. In essence, patience is the final, yet most critical piece of the investment puzzle. It transforms a well-researched stock pick into a profitable investment over time. So, stay the course, remain patient, and let time be your ally in the journey to investment success. Pause twos. Thank you for watching. If you enjoyed this video,